Hello, everyone, and welcome to this podcast coming from the ESCoE Conference on Economic Measurement here at the University of Manchester. And I'd like to introduce L Mann, who's just given an excellent keynote speech to the conference. Catherine is an external member of the Monetary Policy Committee, very soon to be an honorary professor here at Manchester and part of the research programme for the Productivity Institute, which is based here at Manchester. And Catherine has connections with a very wide range of institutions, probably too many to mention, but Citibank, OECD, the Federal Reserve, European Investment Bank, as well as being a professor at Brandeis University. So I'm going to ask Catherine a couple of questions, mostly related to the keynote, but also related to economic measurement. Okay, so let's start by, your keynote was about investment. So start by telling the audience why this matters. Why is investment an issue?
So when we think about why investment matters, we step back and say, when we think about growth in an economy, we're actually thinking about it in terms of higher growth delivers higher living standards. And we can define that broadly to include health and wellness and nature, as a number of students have been working on those topics. And there were presentations in the poster session from ONS on natural capital and health and so forth. So we care about living standards. I mean, that's our objective as policymakers, is to enhance living standards. And investment is a key ingredient to enhancing living standards in an economy. And investment is both actual capital, tangible and intangible capital. Innovation is a way of enhancing living standards. So broadly speaking, as a policymaker, I care about investment because it is a fundamental source of higher living standards for people in an economy.
And investment, is it more of a problem, lack of investment in the UK?
So yes, I think there's a number of people who have been focused in this conference on showing the extent to which business investment in the UK is at sort of weaker than in other advanced economies, and has been weaker than other advanced economies for an extended period of time. And we can see not only is investment weaker than other advanced country peers, but also that innovation, we can measure it a couple of different ways. I mean, sort of an economist terminology is multi-factor productivity growth, but that means innovation. It means transformation in products, processes, and workplace practices. Frankly, for the UK, there's been a deterioration in this pace of transformation, innovation, productivity growth that has been quite dramatic over the last 30 years. Innovation, again, a critical ingredient in higher living standards. So of course we care when we see this kind of slowdown.
Okay. So in your keynote speech, you talked about three actors and analytical perspectives that influence the amount and type of business investment. So do you want to describe a little what these actors are and why they matter?
Right. So business investment has to be conceived. What do you think you might want to do? Managers have to evaluate that investment as to whether or not it's going to generate a rate of return in the company. And then financiers have to finance it. So when we think about the three different ways of thinking about the investment decision, an economist way of thinking is a present discounted value of a future stream of earnings is positive, and so an investment under those kinds of environments would be undertaken. There's a cash flow question. How do we evaluate cash flows? There is a discount rate question. What is the appropriate discount rate for a net present value calculation? And there's a horizon question. Over what time period do we expect to have these cash flows generated? So an economist has a nice structured way of thinking about whether or not investment is going to be undertaken. We can place against that kind of framework a manager's decision. A manager also is evaluating projects. They have a question as to what cash flows of this project might be. And it may be the same as an economist, but maybe it's different. And some of the reasons, and they also have a question about what should be the discount rate. What is, and a manager thinks about that in terms of their cost of capital. And how do they measure the cost of capital? Do they measure it based on a cost of a loan that they would need to undertake to take out to do this investment? Or are they considering the cost of equity to finance this investment? Do they look at internal funds? There are all these different ways. But managers also can look at a question of, I think they can sort of put the manager hat on. I'm going to communicate to the market that I am undertaking only the best investments. And those have high hurdle rates because I want to show that, as I say, it's a guidance to the market that, to the financial market, that I am undertaking the best investment. So hurdle rates, which is an ex ante cost of capital, managers choose that's ex ante for a number of different reasons. And that may be a higher cost of capital than the actual one based on loans or debt finance. Now, again, financial institutions and equity markets also play a role here because you have to ask the question, what cost of capital do they have? They have cost of funds. And then how does that translate into the return on the investment that they're going to make to the company? They're going to make a loan to the company, or they're going to buy equity shares in the company. And so what drives their decision about rate of return? So when we put these three different ways of analytical perspectives together, it's only when the three of them all are in alignment that we actually get any investment being undertaken. And the three approaches have may well have different cash flow estimations. They certainly have different assessments on what the return to the investment needs to be. And they have very different views on the horizon over which the investment equation is being calculated. So they have to get them all together in a Venn diagram. It's where the three of them overlap that you actually get an investment undertaken. But that's not the end of the story, because investment can take the form of a tangible investment, an intangible investment, or it can take the form of a merger and acquisition, equity buyback, financing for an equity buyback, or other sorts of financial investments. Mm-hmm. So it's actually a very complex set of variables that are at play when we think about business investment in an economy, and particularly in the UK economy.
Yeah. So the cost of capital is central. There's also other things that impact on the investment decision. Do you want to say something a little bit about that, and a little bit about the evidence already out there for the UK?
So when we look at these different measures, so if we focus on the cost of capital and these different measures of the cost of capital, because that was what I was talking about today, was the cost of capital and measurement issues and research opportunities to investigate implications for the UK investment climate and outcomes. One of the things we find is that the hurdle rate, that again is a management ex ante decision, is much higher than any of the other measures, ex post measures of cost of capital, either based on loans or on equity. And so if we think there is a correlation between the cost of capital and the business investment outcome, then the fact that hurdle rate is high is something that would, everything else being equal, would be associated with a lower rate of business investment. So we do think that there is some relationship between a hurdle rate and business investment. We also think that there's a relationship between the gap between the hurdle rate and the ex ante hurdle rate and the ex post weighted average costs of capital, that gap varies over time. And so when that gap varies over time, if we do econometric analysis with a cost of capital on the right-hand side and business investment on the left-hand side, then the variation in the hurdle premia is going to be important for thinking about the sensitivity of investment to these measures of the cost of capital. So from an econometric standpoint, it's very important to think about just not only the level of these various measures, but also the gaps, the time-varying gap between them. However, when we do these kinds of analyses, we also find that more important, even than the cost of capital, more important is what companies think about their sales prospects, the marketplace characteristics, their prospects for selling their product into the marketplace. So in a broader range econometric exercise, when there are multiple variables on the right-hand side being determined, being a driver of business investment on the left-hand side of the equation, the ones that are more important than the various measures of the cost of capital, more important are sales prospects. And when we think about sales prospects, we can think about what's more important, quantity or price. And of course, both of them matter. But when we think about quantity and price, what we find is that quantity sales is a more important driver of business investment than price. Now, this shouldn't be a surprise if you're competing in the marketplace and you're competing for market share, and you gain market share, so you're selling more widgets, then you would need to invest more in order to produce these widgets that you're selling into the marketplace. Whereas if it's an uncompetitive marketplace, so you're not competing for market share because you own most of it, then you can generate sales increases off of increased prices. And we find that price increases are not particularly strongly related to the need to have business investment being undertaken.
Yes.
Yeah.
So you're now part of the Productivity Institute and in charge of the finance investment stream of the Productivity Institute research. So do you want to say a little bit about what areas you're going to focus on in that research? And this is a 2-year program of research which you're just going to undertake.
So a couple of observations that I made in today's talk, but also have been outlined in more detail in the framework paper that goes through the Venn diagram and so forth, that came out of NISR and Productivity Institute. Both have it available. The observation in the UK is that business investment is really quite concentrated in a small share of multinational firms. 50% of investment is undertaken by 0.5% of firms, many of whom are multinationals. So the size distribution of firms is a very important lens for thinking about prospects for business investment. There is similarly a quite concentrated financial environment in that the financial ownership of firms in the UK is quite concentrated in large financial institutions and very few large financial institutions. So there's two forms of concentration, firms themselves, but also financing of firms. So that, to me, creates a very fertile research environment when we look at to what extent do concentrated financial ownership, how does that affect the concentration of firms' investment outcomes? And so to me, this is a very natural pairing of the research question. And again, when we think about cost of capital, because it is still relevant, that high variation in the cost of capital across firm size and how is that related to the financial ownership characteristics? So I think there's quite a lot of work to be done here on this intersection of financial ownership and business investment outcomes.
Yeah, so it sounds fascinating. I'm sure we'll see some really great output coming out of this. But this is a conference about economic measurement,
Right.
and I'd like to get some sense from you. Do you face some constraints in the type of data that you have access to? Do you have a data wish list?
So constraints, I think one of the so first let's start and kind of acknowledge that all of the work that we need that we do and that we need to do on these kinds of questions, it's all firm level data. Macroeconomic outcomes are the sort of the big picture, but to understand the dynamics of the macroeconomic outcomes, you have to look at the firm level data and the firm level behaviors. And so, once we start there, we know that firm level data is often challenging to work with. There are questions about access in terms of cost, and there is in an environment where I am giving this example, where I'm bringing together firm level data, and I want to bring it together with understanding financial ownership of firms. That is a completely different data set, because it's at the granular level of financial ownership. So that you have both who the finance company is, but also who it is that they have engaged with on the business side. So there's quite a bit of interlinking of data sets that is a precursor to doing this kind of analysis. And that, wrangling that data down so that it actually can be used effectively for these kinds of questions is a time-consuming process. And it's also it requires a degree of attention and skill before you even get to answer your questions. So access is an issue, but the challenge is very much the actually wrangling the data down.
Yeah. And of course, the remit of ESCoE is to make that link between academic researchers and the people producing the statistics. And ESCoE is part of the Productivity Institute, so it all comes together.
Yes.
And hopefully, with this, with working together, come to enable you to have the data that you need to answer these very really important questions. There's no doubt the questions you're asking are at the heart of the productivity issue in the UK.
So I think when I going to the poster sessions last night and so forth, which I really enjoyed seeing what was being done. It's important to have multiple opportunities for the statistical authorities and some of the private sector providers of data, right? Because there are some private sector providers to interact on an ongoing basis with the research community. Because there are occasions where new statistical databases are being created, and the research community takes a while for that to filter out to the research community. And so it's an interesting question how to make sure that the research community is aware on an ongoing basis of what new data sets are available.
Yes, and it's a rapidly changing landscape. But it's nice that we have a few representatives from some of these private providers who were here at the conference in Manchester. So
very good.
And maybe we just need to find get more of these people in and talking to us.
Yeah.
So thank you very much for outlining your research agenda and your keynote. And
well, I've been delighted to be here. I really have enjoyed the good set of questions that came out after the keynote, and it's been a good conference. Thank you.
Thank you.